Okay, so let's get more on this now with Randolph, the head of sovereign risk at IHS Global Insight. Thanks so much for coming here to speak to us. So what do you make of the role played by rating agencies in Europe's debt crisis?
Well, we've seen how important they are. A lot of power is effectively invested in them because their ratings are so regularly used in fundamental credit decisions, in terms of limits, in terms of capital at risk weightings, and there's only three of them. If they get a credit opinion wrong, and that, remember, it's just a credit opinion, it's take it or leave it, it can create a lot of damage. And regulators are quite rightly worried that too much has been outsourced of this key core competence, which is to measure risk, which should really be the undertaking of financial institutions themselves rather than being taken off the shelf from some of these rating agencies. So there's a real issue there.
So take us through then the impact of a credit downgrade for a country like Greece, for example, because of course many institutional investors like pension funds can only operate within certain parameters and under certain rules, right?
Yeah, I mean, it's true that, for example, many of the longer-term, more conservative investors have an investment-grade ruling as part of their own credit policy. And so when sovereigns or others fall below investment grade, that can, basically there's an automatic sell-off because they're not allowed, they're duty-bound not to expose themselves.
So they have no choice but to dump Greek government debt?
Yeah, I mean, it is part of their own policy. They've linked a lot of their credit policy, a lot of their investment portfolio to these ratings. And so when these ratings move, there are very important implications out there.
So why do they place so much emphasis, so much faith in these ratings?
Well, because they provide something very, very useful. They provide a credit opinion, and it's supposedly an independent opinion, and it's all part of the due diligence process that all financial institutions should be undertaking, a second opinion to the one that's internal. The real problem, I think, now is that a lot of financial institutions don't do their internal ratings, so they don't have their own opinion, and so they rely very heavily on these outsiders.
I suppose credit rating agencies would argue that the debt crisis in Europe is essentially rooted in the economic fundamentals, that you have these countries with massive budget deficits that have been spending beyond their means.
Yeah, I mean, we are living with the tail risk of having rescued the global economy over a year ago, and that tail risk is sovereign risk. And it's a widespread problem, but obviously there are some countries in the front line here.
So how do you make the system more effective? Because you have countries like Greece with a deficit amounting to nearly 14% of GDP in a fiscal position that is extremely dire. Shouldn't something have been done about it earlier, given that Greece has a history of economic problems? Should the rating agencies have issued warnings, say, well, perhaps even a couple of years ago?
Yeah, I think one of the bindings that the rating agencies, they had been criticised in the past of being too slow, being behind market developments. So in a sense, they're playing a bit of a catch-up. They don't want to be caught out again. And so they're being a little bit more aggressive than they had been in the past. But I think the fundamental problem, really, it goes back to the financial institutions themselves that are actually running the risks. They should be doing the ratings themselves internally.
They should be doing their own assessment.
Yeah. I think there is a certain regulatory pushback now. The regulators are becoming much harder on this. They're getting the banks that they regulate to do more of their internal ratings rather than reliance on outsiders. And I think there's only three of them. I think everyone agrees that there should be more competition. I think that goes without question. I think the more competition, the better here.
So could we then, looking ahead, see regulations imposed on rating agencies to perhaps prevent them from automatically issuing credit downgrades, particularly during times of tension and turbulence on the financial markets?
Well, it's a difficult one. I think that the criticism of the rating agencies themselves is really within their business model. In the past, it was lenders and investors that bought the credit opinion. Now we've got into a situation where it's the issuer of the security or the issuer of the debt that pays the fee to the rating agency, and there's an inherent conflict of interest there, and that needs to be looked at, I think.
Randolph, thank you very much for sharing your insight on this story, on this issue. Appreciate it.